In 1923, Joseph Bear and Robert Stearns started a small trading firm. They had one office and a handful of employees. Their focus was simple: stock trading. Over the decades, Bear Stearns grew steadily. It survived the Great Depression and thrived in the post-war boom. By the 1980s, Bear Stearns had become a major player on Wall Street. It was known for its aggressive entrepreneurial spirit. The firm's success attracted ambitious young talent. They were drawn to the fast-paced, high-stakes environment. Bear Stearns became a training ground for future Wall Street titans. Its culture emphasized taking risks and reaping the rewards. This approach would bring both great success and, eventually, catastrophic failure. Bear Stearns developed a reputation for being fiercely competitive. Its traders were known for their sharp elbows and willingness to push boundaries. This aggressive culture was encouraged from the top down. The firm's leadership believed in taking calculated risks to achieve outsized returns. This often meant investing in complex financial instruments that others shunned. One area where Bear Stearns made its mark was in mortgage-backed securities. These investments pooled together thousands of mortgages. They offered the potential for high returns, but also carried significant risk. Bear Stearns dove headfirst into this market, becoming a leading player in the burgeoning industry. The firm's traders became masters at packaging and selling these securities to investors eager for yield. For a time, this strategy seemed like a surefire winner. Throughout the 1990s and early 2000s, the housing market boomed. Home prices soared, fueled by low interest rates and lax lending standards. Bear Stearns capitalized on this trend, aggressively expanding its mortgage-backed securities business. The firm's traders became increasingly confident, believing they had found a formula for endless profits. However, beneath the surface, trouble was brewing. Many of the mortgages being packaged into securities were subprime. This meant they were given to borrowers with poor credit histories and a higher risk of default. As long as home prices continued to rise, these subprime mortgages seemed safe. But if the market turned, the entire house of cards could collapse. Bear Stearns, blinded by its own success, ignored these warning signs. The firm continued to churn out mortgage-backed securities, betting its future on the continued strength of the housing market. Section 4. Reaching the Summit. Bear Stearns at the peak of its power. By the mid-2000s, Bear Stearns had reached the pinnacle of its power. It was one of the most respected and feared investment banks on Wall Street. Its stock price soared to new heights, reflecting the market's confidence in the firm's future. Bear Stearns executives were feted as financial wizards, their every move scrutinized and imitated. The firm seemed unstoppable. However, the seeds of its destruction had already been sown. The firm's aggressive investments in mortgage-backed securities had left it highly vulnerable to a downturn in the housing market. As long as the music kept playing, Bear Stearns could keep dancing. But when the music stopped, as it inevitably would, the consequences would be disastrous. Section 5. Cracks in the facade. The subprime mortgage crisis unfolds. In 2007, the long-brewing subprime mortgage crisis exploded. Home prices began to fall and defaults on subprime mortgages surged. The market for mortgage-backed securities, which Bear Stearns had bet so heavily on, collapsed. The firm's losses mounted quickly, eroding investor confidence. As the crisis deepened, Bear Stearns found itself on the brink of collapse. The firm's massive exposure to toxic mortgage-backed securities had crippled its balance sheet. Its once sterling reputation lay in tatters. As panic spread through the financial system, Bear Stearns desperately sought a lifeline. It needed a buyer, and fast, to avoid a complete meltdown. The once mighty firm was reduced to pleading for its survival. Section 6. The fall of a titan, panic, loss, and the end of an era. In a frantic weekend of negotiations, JPMorgan Chase agreed to buy Bear Stearns. The price of a paltry $2 per share, a stunning fall from grace for a firm once valued at over $170 per share. The deal, brokered by the Federal Reserve, was a fire sale designed to prevent a wider panic in the financial system. Bear Stearns, once a symbol of Wall Street might, was no more. The collapse of Bear Stearns sent shockwaves through the global financial system. It served as a stark warning of the dangers of excessive risk-taking and the interconnectedness of the financial world. The firm's demise marked a turning point in the financial crisis, signaling that no institution was too big to fail. The lessons learned from the fall of Bear Stearns continue to resonate today, reminding us of the importance of prudence, regulation, and a healthy dose of skepticism when navigating the treacherous waters of Wall Street.